So this is going to be a video about Lyons Bancorp. This is an OTC traded bank, ticker symbol LYBC, and they are focused primarily in upstate New York. Founded in 1852. Been around for a very long time. And I'm going to just jump into some of the more fascinating things that I've seen about this bank. On page 7, you see incredible loan growth, incredible asset growth, strong equity growth, and of course they want to put themselves on some very good footing right at the onset. Moving on down to page 7. They actually show total gross loans growth growing from $605 million in 2015 to $863 million in 2019, and net charge-offs, net charged-off loans to average loans, growing from 0.11% in 2015 to 0.10 in 2019. They experienced a very sharp increase in 2016. While their peers kind of maintained steady net charge-off loans to average loans. They mentioned here on page 7, total loans were $862.5 million at the end of the year in 2019, an increase of 6.5%, with 46% of those loans being consumer-related loans versus 54% commercial-related loans, a small change from last year. And they mentioning they are well positioned to continue prudent lending to individuals, families, and businesses in the upstate New York area, and look forward to another year of solid growth. Their investment portfolio, moving down to page 8, it consists primarily of U.S. agency debt, mortgage-backed securities guaranteed by the U.S. government or issued by the Federal Home Loan Bank, and state and local government debt. Their investment portfolio totaled $214.3 million, an increase of $22.4 million. And I would like to point out that that is, once again, $214.3 million with a rather lower market cap. Market cap of $109 million and investments of $214.3 million. Right out of the gate, that's kind of what got me interested in this bank in the first place. Why are the investments that they have so much larger than the market cap? What is going on here that this might be rather undervalued? Is it for good reason or not? I would like to find out. They're showing here some of the highlights. Total equity has increased. Book value has increased from $58.7 million to $86.8 million. Total deposits have increased as well, 772 to 1,029, or 1.02 billion, and dividend payout ratio is pretty high. They paid out almost 45% of their net income in dividends, a dividend payout ratio of almost 45% in 2017. They seem to be very generous to their shareholders. A return on average assets of 0.98%. Okay, that's nothing really new, but it is growing over time. And return on average assets, return on average shareholders' equity of 12.99%. The bank is 8.44% levered, and it's trading at a premium to book value per share. Kind of want to skip over some of this fluff to get to, I guess, the meat and potatoes of what I would like to show. Is pretty interesting with this bank, I think. Kind of get really family friendly here with trying to give a good picture of the bank. It seems to be a pretty small community. It's a pretty small bank, 1.16 billion in assets, and only 16 branches in the upstate New York area. Looking at their audit statement, Bonadio and Co. Audited them, and I'm immediately looking for the magic phrase "in all material respects." So now I can at least say, okay, they looked at it, an auditor has looked at it and signed off at least on that much, and we can move on. Mentioned here total investment securities $214.3 million. Once again, net loans have increased rather substantially. Total assets have ballooned as well between 2018 and 2019. I have a spreadsheet here showing just some various growth calculations from these past 2 years to see how they're trending. Total equity has increased rather substantially as well. Retained earnings the same. And to see how, and obviously they make the vast majority of interest income off of their loans. Nothing new about that. The vast majority of investment securities income that they make is from taxable investments. And that has grown rather substantially as well, from 3.6 million to 4.83 million. The vast majority of their interest expense comes from deposits, and that has ballooned over time as well. Non-interest income, 13.43 million. Adjusted, if you want to pull out this 1.2 million, a gain from Bali, death benefit. Their chief risk officer died, and banks take out bank-owned life insurance on their employees, so they experienced the one-time charge because you can only die once. So they did not make 13.4 million. You can just subtract that out. So 13,431 minus the 1,227, 12,204. Divided by their current shares outstanding, or you could just pull it out of net income to get a different, get a lower earnings per share. So minus the 1,227, 9,528, divided by their shares outstanding. I'm going to use my cheat sheet here. Shares outstanding at this time was 3,170,000. $248, so you actually get an earnings per share of at least $3, which, okay, at least we get a cleaner picture. Now I want to move on to some of the more interesting stuff. So right out of the gate, I am fascinated by why their investments are not being reflected in the share price, because their investments per share are at $66.65. It is not there, and I would like to know why. And the problem is that I have been trying to figure it out and can't figure it out. So on page, I'm going to skip down a little bit, page 22, they start talking about their investments. They're primarily invested in Federal Home Loan Bank of New York stock, restricted equity securities, and it's held for regulatory purposes and for borrowing availability. These securities are carried at par, which is also cost. The company has an investment in Federal Agricultural Mortgage Corp, Farmer Mac, Class A stock totaling $168,000. And restricted equity securities are held as a long-term investment. Value is determined based on the ultimate recoverability of the par value. And the company has concluded that the par value of these investments will be recovered, and as such has not recognized any impairment on its holdings of restricted equity securities. Okay, so right out of the gate, their investments consist of Farmer Mac and government and municipal investments. So does the market question the safety of this? I don't know. And moving on along to page 22, 60 securities with unrealized losses at December 2019, 48 securities with a value of $72.4 million, and 12 securities with a value of $27.7 million. Compared to last year, they actually shrunk. They went from 165 securities with unrealized losses to 60 securities with unrealized losses. All of their unrealized losses were caused by market interest rate changes from those in effect when the securities were purchased. The contractual terms of these securities do not permit the issuer to settle the securities at a price less than par. Okay, so that is fascinating. So it has to go back. Except for certain state and local government obligations, all securities rated by an independent rating agency carry an investment grade rating. And they did not consider these investment securities to be other than temporarily impaired. Okay, so right out the gate, I get the feeling that a lot of these investments that they have are safe because it is not allowed, at least by the contractual terms of these securities, the issuer can't settle them at a price less than par. And everything carries an investment grade rating. Okay, so immediately I am assuming that they are safe. So why the discount? Does the market think that they're not going to realize the fair value of these investments in time? And the vast majority of these investments are due within 5 to 10 years, the fair value at least being 61 million. And the company sold 38.9 million of it available for sale during 2019. Gross loss on the sale of investments this year was last year was 222,000, which is a massive increase from the loss that they had last in 2018 of 35,000. Going on to their loan book, the vast majority of their mortgage loans on real estate come from residential 1 to 4 family, and commercial is the second largest after that. Total consumer installment loans, primarily direct consumer installment loans, and a large bulk of their loan book is also commercial loans as well. And the fun stuff of what is outstanding 90 days and greater. And I'm going to move to my spreadsheet to kind of show. What I've got here. So they've actually grown their loan book from 2018 to 2019. Their 1 to 4 residential real estate has grown almost 13%. Agriculture has also grown 10.76% from 2018 to 2019. I'll leave all this up in the description section in the video, and I'll leave the link to the annual report as well. Total loans have grown. Total consumer loans have grown 6.46%. Total mortgage real estate loans have grown faster and larger at 7%. Then you get to the loss reserves that they have for each. I'm actually going to jump back here for a second. The vast majority of their loans that are 90 days greater come from commercial loans, and then after that, agriculture loans. Loans on non-accrual, they have about 1.6 million on non-accrual for commercial loans. This seems to be the biggest headache that they have. When we jump down to how it was last year, in commercial real estate, was actually the largest part, but they didn't have a headache with that much with commercial real estate loans compared to $157,000 last year, 90 days greater, $157,000 worth of loans that were 90 days and greater. $703,000 worth of commercial loans were 90 days and greater. So commercial loans have been a problem no matter what they do. And onto their loss reserves on page 25. I'm actually going to move because I have it a little bit neater here. Their loss reserves for commercial loans has shrunk over the year. They went from 486,000 for loan loss provisions to negative 74,000. And the other one that shrank was agricultural real estate from 91,000 to negative 34,000. So immediately I'm intrigued why they're shrinking if they're having problems with 90 days or greater. There were no loans over 90 days delinquent and still accruing interest at December 31st, 2019 and 18. Moving down to their impairment and how they allocate for it. Their loss reserves, I want to focus on this a little bit. Their loss reserves for consumer grew by 506%. Their unallocated amount shrank, so keeping that there just for the show and just to show that that's accounted for. CRE, commercial real estate, ballooned 94% to 1.6 million. And their loan recovery ability I think I actually skipped over it. Sorry. Let me go back here just because I have the information aggregated here. They're actually able to recover a lot of their commercial loan book, but their CRE has been a big problem. The commercial real estate, they're not able to recover a whole lot of it. That actually shrank from 2018 to 2019 by 44%. Ultimately, this commercial real estate, commercial lending is a bit of their biggest problem, and also agricultural real estate. I don't know why they shrank the reserves for the loss reserves for commercial and agriculture. I don't know what kind of confidence they have in those areas, but whatever it is, it seems to be very brazen. They break down the way that they rank their credit quality on page 29. They utilize a 10 grade internal loan rating system. 1 through 6 are pass, 7 special mention, 8 substandard, 9 doubtful. They don't have any doubtful loans. 10 uncollectible, completely write off a loss. No loss loans. No 9s and 10s for the past 2 years. And the vast majority of their substandard loans have come from agricultural real estate. This year, 2019, and substandard came from commercial in 2018. Right at the gate, they have headaches with commercial and agricultural lending. So why they shrank their loss reserves for those areas is rather fascinating, and also a question for deeper research. Their non-accrual loans for 1 to 4 family are the largest here. And they were also the largest in 2018 as well. That doesn't really surprise me, actually. Talking about their leases a little bit. What their borrowings consist of. On page 32, they mentioned borrowings consist of overnight advances and amortizing borrowings. They had 25 million overnight borrowings in 2019. As a member of the FHLB, they are allowed to use certain unencumbered mortgage-related assets to secure borrowings from the Federal Home Loan Bank. Total unencumbered mortgage-related loans were $100.2 million as of 2019. They have unsecured line of credit agreements with correspondent banks permitting up to $40 million maximum, and no outstanding advances against those lines. So they have some breathing room. They've issued junior subordinated debt that comes due in 2033 and 2034, and it's callable at par, basically at any time right now. Skipping down to something I just found fascinating, how they deal with their pension. The company participates in the New York State Bankers Retirement System, a non-contributory defined benefit pension plan covering all their employees. And that pension plan, this is what I got. This is, I guess, what I found fascinating. I could get to it. The system had approximately 98% of its total portfolio in the JPMCB LDI Diversified Balance Fund. And that is managed by trying to find the fun part there. It's managed by JP Morgan, which, not gonna lie, I guess this kind of told me the vast breadth of how much JP Morgan handles as a bank. 98% of the total portfolio is in that diversified balance fund, a commingled pension fund trust. And they mention some of the valuation techniques that fund trust uses. So the commingled pension trust fund here is the CPTF, strategic property of JP Morgan Chase Bank. Principal valuation techniques used: market, income approach, debt service, and sales comparisons on page 44 here. And the unobservable inputs that they use for a lot of these calculations: credit spreads, discount rate, loan to value ratio, terminal capitalization rate, and value per square foot. I've never seen stuff like this so outwardly laid out and just cleanly mentioned that this is how they calculate it. These are the techniques that they use. I actually found this really fascinating because I guess it gives me more insight into the process and how they actually do a lot of these things. And they talk about the breakdown of the pension fund established in 1938. The fund employs a liability-driven investing strategy for pension plans that are seeking a solution that is balanced between growth and hedging. And the fund's primary benchmark is against the Barclays Long A U.S. Corporate Index. The portion of the fund will comprise between 35 to 90% of the portfolio and invest directly or indirectly in a broad mix of global equity, credit, global fixed income, real estate, and cash plus strategies. Even lay out the rules for the pension plan and how things can be invested and how they use their assumptions in determining the long-term rate of return. For the equities, they use dividend discount models, smoothed earnings yield model, equity risk premium models, yield to maturity models for fixed income securities, and the rules of what they can't do. They can't short. They can't purchase on margin, and they can't have any unregistered securities. And for fixed income, they can't invest in mortgage-backed derivatives with an inverse floating rate coupon. Any asset-backed security isn't issued by the government or its agencies, and securities of anything under BBB quality or bond securities of less than A quality can't, in the aggregate, exceed 13% of the investment manager's portfolio. And CMBSs and ABSs can't exceed 10% of the portfolio at the time of purchase. They also can't invest in unhedged currency exposure in countries not defined as high-income economies by the World Bank. I find this stuff kind of fascinating, the rules by which these big guys have to play, because no one else really talks about that. They bring up their target allocation for 2019 and actual allocation of plan assets, and this is kind of cool to see, I guess. Once again, how the big boys play, and this is actually on page 47. What you see here is they had a target allocation of 0% cash. They want to be fully invested, which is gutsy. They wanted to have 28% target allocation to equities. They had 31.8, and they're undershooting the other two. Fixed income at 57.7, but a desired 60% target allocation. Other financial instruments, 12%. They're at 10.6. They have a lot of standby letters of credit that they've agreed to. Underfunding commitments under commercial lines of credit are the vast majority of their standby letters of credit. And they have a concentration of their customers. Concentration of credit on page 50. The vast majority of them are in communities in the New York State. The largest concentration of credit is lessors of residential buildings and dwellings, with 7.37% of their loans being there. And they do their best to try to undermine the risk that they take on. Here they're talking about their capital buffer on page 50. 53 over here. I think they're very well capitalized, sitting a risk-based capital ratio of 12.3% and a CET1 ratio of 10.6%. And it seems to be pretty consistent. They float around, not fluctuating a little too much. 12.3% for 2018, 12.3% for 2019. That's good. 10.5% for 18 and 10.6% for 19. So they have a lot of cushion for those 16 branches. They have a very safe cushion to fall back on. The vast majority of their service charges on deposit accounts come from insufficient funds fees. That's been growing rather substantially. Cardholder fees, debit card interchange fees, same. A large chunk of their revenue comes from this rather than other cardholder fees. And a lot of financial service fees for their revenues as well. Keep scrolling down, and they list the addresses of all their branches. Auburn, not even going to try to pronounce that. Macedon, Seneca County, Parenton Bank, Newark, New York. This is upstate, very upstate New York, and I'm not too familiar with the area, to be quite honest. I'm going to move on to my spreadsheet. Their assets have grown from 2015 to 2019 at 7.62%. What I found that's why I've highlighted the red as something I just found fascinating, interesting. The interest expense has also grown by 24.81% over the same time period. EPS has grown 8.16%, book value per share at 7.83%. ROE has actually shrunk, and a payout ratio has increased to 4.65%. Now on to the difficult part for me, at least the valuation on a deposit basis. They're sitting on deposits per share of $324.73, and they've earned 4.68% on their loans. They paid 1.32% on their deposits, and the cost of their deposits was 3.41%. The cost to keep them was 2.08%. So right at the gate, they aren't lending lower than the market rates for money. Which is the AAA corporate bond rate. You can just look up the AAA corporate bond yield today. They are not doing this cheaper than the vast majority of banks right now. It's actually cheaper to get money out in the open market right now than it is to get through Lyons Bank. Their economic value margin, if you use the 2.22%, and I did this two ways here. I used the long-term average of 6.71% and the AAA bond rate today at 2.22%. So the economic value margin is either negative 1.19% or 3.30%. And that's a very wide swath to cover. So what I ended up doing was I ended up taking deposits per share multiplied by the economic value margin. You get negative $3.85. And I do the same thing with the the long-term average of 3.30%, and I get $10.73 per share with an intrinsic value of either nothing or $107.32. So right at the gate, I have a hard time trying to figure out what is the actual value of this bank. So I'm kind of looking at this going, okay, it's either worth way more than it currently is, or it's worth nothing. Well, it can't be worth nothing. And that doesn't seem like it would be the case. But also what their investments per share look like here tells me something is a bit off here. Something looks dislocated because if anything, their investments are safe and worth way more than the current market cap. I'm going to keep looking into this bank because I do find it interesting. But this is what I found, and I wanted to show the viewers here that I think this could be a good opportunity but it will involve a little more research on my part. please comment, critique, or if you know anything about this bank or anything on the upstate New York area. I want to keep the spreadsheet open so that you guys can mess around with some of the calculations, so on and so forth. And link also the annual report to the description section as well, so that you guys can see where I was looking directly. This is once again a video for Lyons Bancorp. Thank you for your time and thank you for watching.